I think the big question out of the Fed meeting this week that hopefully you can clarify is, what does substantial progress look like on your goals so that you would consider paring back the asset purchases?
Well, Sarah, I think the chair said it very well. Substantial progress means we want to make substantial progress to reducing unemployment and moving inflation back close to our 2% goal. The coronavirus dug a deep hole for the economy. The recovery so far has been robust. There's a way to go. And so substantial progress obviously will come into view as we get closer, but that's a ways away. So right now the focus is on providing the support the economy needs to get us through this tough stretch.
But I guess it does feel a little ambiguous, Mr. Vice Chair. Why not set specific markers so that it is actual guidance?
Well, Sarah, we set specific markers for interest rates at our September meeting, and we think that it's appropriate with regards to the asset purchase program to put down markers in terms of substantial progress, as we've indicated. And again, our communication, our SEP projections, as we get closer to that point, it'll become clear. We think right now this is the best way to communicate our goal to really provide the support the economy needs right now.
There was some surprise and maybe a little disappointment that the Federal Reserve didn't go even farther, perhaps increase the weighted average maturity, focus on the long end of the curve. Why did you decide not to do those things, which would have been considered stimulative at a tough time?
Well, Sarah, we think we are providing very ample support for the economy with the combination of our guidance and these purchases, which are at a very, very robust pace, $120 billion a month. We think that the interest-sensitive sectors in the economy, autos, durable goods, business investment, are all responding to low rates. The contact-intensive service sector obviously is being hampered by the virus. And we think that the current constellation of policy is exactly where we want it to be. Chair Powell also indicated, Sarah, at the press conference that, of course, in future meetings, we're going to be assessing the situation. And there are things that we could do with regards to the maturity of our portfolio. But right now, we like the setting of where policy is, and we think it is providing very important support to the economy.
One of the worries is the near term, and we've seen it already deteriorate. Retail sales, jobless claims. How likely is it that we could be looking at a double dip recession?
Well, Sarah, I certainly hope we don't have a double dip, and I don't think we will have a double dip, but you are correct. The surge in hospitalizations and new cases is clearly impacting the economy. We're seeing it in some of the data that you've referenced. And as we've said, we could have a rough couple of months in the data. But on the other side of this, of course, we've gotten very, very positive news on multiple vaccines that are not only safe, but effective. Indeed, this week we began to have those vaccinations deployed. That makes me individually very optimistic about the economy as we get into 2021. Indeed, I and most of my colleagues revised up our outlook for the economy over the medium term, over the next several years, notwithstanding we acknowledge what could be a rough couple of months because of the increase in cases.
Well, the other factor there, of course, is fiscal stimulus. And I know that you and Fed Chair Powell and so many other economists have called for Congress to do something. They're discussing it. The latest hiccup is actually a new provision introduced by Pat Toomey, Republican senator from Pennsylvania, who actually wants to include a provision that would not let the Fed revive its emergency credit lending facilities. Would that be a mistake?
Well, Sarah, obviously, I'm aware that those conversations and negotiations are ongoing on Capitol Hill. I'm not a party to them, so I won't have anything to say on that beyond what we have already said, that Secretary Mnuchin, as Treasury Secretary, has indicated that the Treasury would like the programs to end as of December 31st and for the Fed to return the unused Treasury investment, the CARES Act appropriations, and we will do that. But beyond that, I don't have anything more for you on the current discussions on Capitol Hill.
Well, leave the discussions aside for a second. Would it be dangerous if the Federal Reserve legally were not allowed to revive those credit facilities in the case that the economy and the markets would need them?
Well, we have said, and we do believe that the 13.3 facilities, which are only really triggered in what are called unusual and exigent circumstances in the legislation, were very important, provided very important support to the economy. So there's no doubt that the 13.3 facilities were very valuable, and certainly we would certainly expect the 13.3 provisions to continue to be available to us. But again, I'm not going to have any further comment on the discussions on Capitol Hill.
Shepard Smith here. Thanks for watching CNBC on YouTube.